Hey everybody, welcome back. S&P, another all-time high. As you know, these Saturday videos are the prep us for the whole week. This one is packed. There are parts of this you're probably going to want to watch again. I'm going to help you understand what the heck is actually going on with NVIDIA, what is going on with ARM, why are retail stocks absolutely ripping. There's a lot to go over, so it's going to be packed. A couple of these parts, again, you're going to want to watch over and over again and just pay attention to. But let's just get into it. So we closed at another high. Let's just go to the week and look at the week. And what I want to take away from this is what we always focus on, right? When we look at the macro, we look at the fundamental, and we look at the technical. What I need to do a better explanation of is why are we looking at that? And I'll tell you where I think I could do a better job here. I'll do it this way. So we're all familiar if you've been here with the stool. If you're not, welcome to the stool. This is the market. This is how trades actually get played out. These are the moves that actually affect the stool. At any time that you're sitting on the stool, you could be leaning forward, you could be leaning backwards. Someone explained to me the other day, it's not 3 legs, it's 4 once just hidden, and that kind of blew my mind. Anyway, here we are on the macro side. So when you think about this, what I could do a better job of is this. Macro, fundamental, technical. Well, what are they? Who, what, when? If you think about it that way, who? Okay, when macro changes or fiscal policy or monetary policy is moved in the market, somebody is affected by that. Now, one of the things we went over last week, and we spent some great detail on this, was looking at student loan debt, looking at consumer debt, and how it's actually dropping, where we're seeing it and being told that it's going higher and it's record this and record that as these kids make TikTok videos. And quite frankly, things are way harder now than when I was in my 20s. I mean, you have to be a moron not to say it. Anyway, but if you take a look at the who, okay, that tells you where the money's going. If you take a look at the fundamental side of it, okay, that's going to tell us what is going to benefit from what happened over here. This tells us when to enter those trades, okay? Who, what, when. And sometimes you're leaning on this a certain way, and sometimes you're leaning on the back, depending upon where you are in the stage of the market, right? There's some times where we're going to lean on every word Powell says, and there's sometimes we're going to be like, is that guy speaking again? It doesn't matter. Right. Okay. So keep that in mind now. And I thought that was an important clarification that I could have done a better job with. That's why I spent time on it. If that is not clear, please comment below and I can make it even clearer. But I couldn't figure out for the life of me why retail was ripping. And then when we started digging into those numbers, which we did in the other video, that's why they're ripping, because all of a sudden, student loan debt's dropping. All debt is actually dropping from the peak. But let's look at this chart just for a second and take a moment here. Now, a while ago in September, October, I actually said that this was forming a cup and handle. And we talked about this in great detail. And I was called several different names. I was married once before, so there's nothing you're going to call me that I have not been called before. So if you take a look at this and we clone these, because that is the simplest thing to do, is to clone these. So there you go. And now you're cloned. All right. So what is that giving us? That was giving us a cup and handle. And at the time, I was saying this could be a cup and handle. Wasn't saying it is a cup and handle. Okay. Just like when we went back in, where was it? 23, and that was peak inflation. And I said, you know what? No one's going to ring a bell. And we looked at this chart. You remember this for those that have been with us for some time. And I said, hey, look at this positive divergence that's just absolutely glaring. They're called the 216 bottom. Maybe this is going to bottom here. Again, it's a maybe. It's not this is going to bottom. Why is it a maybe? Because no one really knows what's going to happen. And everything is one thing. You might want to remember that. Just that's it, man. Everything is one thing. So it's a data point, and you look at that data point, and then you see if something is playing with that data point. So I'm going to spend a lot of time, too, on reflexivity today. A lot of people like that concept. I can show you exactly why the net trade worked the way that it did, exactly why the ARM trade worked the way that it did. Just very simple based upon that concept. So we're going to do some of that today. I'm going to start legging into some of these lessons over and over again. There's an educator in the room that explained to me that I need to not just come up with the concept once, but to keep going over it. So here's the cup and handle. And aren't I smart? No. We had Powell come out here and say, what? We're not raising rates anymore. So could this cup and handle have come down here, right? Let's get that little draw tool. Could that cup and handle come down to here? Would I have looked smart? Not as smart. Okay, he could have said, we're going to raise rates again. What would have happened? We probably would have come down. So I would have had a what? A deeper cup. Right? Or a deeper handle. Then from there, what would have happened? Okay, maybe we would have done this in December or January or February, right? Maybe that's where we'd be right now had he not said that. What is important about this? Macro, fundamental, technical. Who, what, when? Okay, if you think about it from that standpoint, it makes a lot of sense because that's not what happened. What happened was this in December, right? This is when he spoke again in December and said, not only that, but we're looking at cutting rates, okay, sooner than we thought. So instead of that, we get this. Now, did anybody know that that's what you were going to get? And if you just do the simplest of things here, I think we can just click right on this for a minute, click on settings, and we just simply hide all the candlesticks, and you look and say, well, that's really what happened. It looks so easy, doesn't it? But it wasn't easy. It was like fighting a battle, right? Hindsight's always easier with technical analysis. Just be aware of that. So this is where we're at. We know why we are where we are. Are we really talking that much about PAL? Yes and no. One of the things we're talking more about is what the heck's going on with the retail names and why are they exploding? And we're going to get to that, because that looks like it's just beginning, not coming to an end. There's a couple indicators that went off, and there's one study that was done over the weekend that I read that I want to share. But all right, so here's our breakout, and this is what we're doing. Now let's go take a look at NQ. What do you notice? The break, the retest, and the go. There's very little to say here, guys. Very little to say. You see the same exact pattern. It happened when? Around the same exact time. The same time that what? That we put the bottom in here with peak CPI. Same RSI over and over again, okay? Macro, who? Fundamentals, what? Technicals, when? Keep that in mind and realize that they're interchangeable as far as when they matter the most. Think about the market that way. Think in terms of things that you can overlay and repeat. You don't need one idea. You don't need to be hot once. You need to be doing the same things over and over and over again and having them work, okay? That's what you need, consistency. You can see how we're boxed in here. This is actually pretty impressive to me, considering what's going on with real estate and REITs. And that's the other thing I want to just hammer home here. Everything is one thing. So when I'm concerned about KRE, and I don't think that people are quite frankly taking this as seriously what happened with NYCB or VLY, it doesn't mean that it's just going to drop in a day. This stuff takes months to develop. Now, anyone that's looking at this chart technically is going to look at this and go, well, you've completely broken. And they'd be right. You could see the left shoulder, the head, the right shoulder, trying to get to the neckline, completely matumboed, and here we go, right? Now we're going to roll. You should be able to see that. But we have some news on NYCB, and I just want to point out this obvious trend line right here. But the important thing about it is with NYCB, we call this painting the tape. And people will say, well, what does that mean? Well, when you have a company and the company's in dire straits, okay, they'll go out there and they'll buy stock. And they'll buy what is a nominal amount of stock, right? And this trick is called, and it's a trick, and it's called painting the tape. So when I saw the buying yesterday and people getting all excited, because they're buying, maybe they're buying for a reason. But I saw this happen with a company called Tyco in 2000. And it was a great example because we saw them buy stock, and then we're like, well, if they're buying stock, surely we should buy stock. Well, then it comes out that the company lent them money to go and buy stock. One thing that was really remiss with NYCB that I didn't see is the CFO did not buy stock. He knows where all the bodies are buried, and he's not buying stock. So if he's not buying stock at $4, what does he know that maybe one of the executive directors he didn't tell yet, right? So you have to look at it. It is what it is. And I'm not saying that they're not going to buy it $4 and all of a sudden miraculously have this go up. But if you're in this, how much money are you actually going to leave as a depositor in this bank right now? When they call you and say, don't worry, everything's fine. You know, I know that you have $500,000 with us and you're only insured for $250 and you're earning 2% or 3%, but don't worry about it. Everything's good. I mean, are you sprinting to the bank or are you taking an Uber, right? Like how fast are you going to that bank to secure your assets? So I think that when you think about it from that way, yeah, they bought stock and maybe that's going to hold it, but maybe not. Right? Maybe it's just going to stab off the inevitable. And then we have what's going on with XLRE. And there was this clip that came out the other day, and I actually shared it publicly in the pre-market. And I would watch the pre-markets, not just for me, but because we share ideas in those pre-markets. So everybody asks questions, and then we come up with ideas. And that's actually how I got back in Mara and went long it and did exceptionally well. I'll show you that trade at the end of the day because people like seeing the P&L. So when I have something worthy of teaching, I'm going to teach it. But where am I going with this? If you look at Mara and what happened here, I didn't come up with this idea. This was not on my radar. I was all about the AI. I was all about that AI life, right? I was not looking and going, you know what I need? I need some more of a Bitcoin miner. And this is the one I like to trade the most. And we had two really good trades in here, and I'll show those later. But that's why the pre-market's so important, because if people weren't talking about these names in there, I wouldn't have done them. So the pre-market, to me, to some extent, is almost, I enjoy it, but I get the ideas from it. So it's almost selfish because I get ideas. And I appreciate that. And then we can look at the ideas together and then make more informed decisions. So I would think of the pre-market live public as not me pontificating as Mount High, but a collective of ideas. So I hope that makes sense. Back to RTY. Let's stay on point, right? Where am I going with this? Well, the mere fact that this is not breaking down and you're facing this is huge, right? But you're still at this level. But are we seeing something a little different? You kind of are. We're not really breaking all the way down. Well, it just hasn't happened yet. Okay, well, a lot of things haven't happened yet, right, in my life. That doesn't mean they're going to happen, right? Or it might mean that they haven't just happened yet. And I'm not going to go through a litany of things, but you get where I'm going with this. My larger issue out there, and this is funny because people will say this to me, oh, well, you brought up this issue. Well, that didn't mean that I thought it was going to happen on a Friday before the market closed, okay? So one of the issues I'm bringing up in XLRE that scares me, and again, I could be wrong. And the fact that we all know it means that I could be wrong. So here's your breakout on XLRE. And I had a bunch of trades in here that I did exceptionally well with. My issue here was this SLG trade we did well with, VNO we did well with. Some of these names have just gotten so beaten up. VICI is the one I like the most because you can't replace their assets. They own the Vegas Strip. You can't even build the things anymore, let alone find the land to build them where they are. This line right here is their book value. If it ever gets there, don't think, right? You'll never see this again unless you have something like this again, where they think that, we're all going to go back to camels or whatever they thought was going to happen there. Who knows? But that panic was real. So anyway, let's get back to XLRA. All right. So here we are and what's happening. What are we going to do here? This is a concern of mine. Evergrande is liquidating all their assets. They were forced by a court. So we're going to get a real mark on where assets are in the commercial real estate market right now. Well, that's a scary place for REITs. That's a scary place for regionals. What if everybody's wrong and these things have more value than we think they do, right? So you always have to look at we're going to get into this, but we're going to get into this in detail today. This is the outcome everybody's expecting, this line, not just I'm drawing a line there. Bear with me, okay? This is the outcome everyone's expectations are. And everybody thinks they know something right here, right? Everybody thinks they know something. So this is the outcome everybody's expecting, okay? This is where everybody thinks they know something. So this is the expected return on investment. Now, let's just say for the sake of argument that this is the expected return, right? Or this is the actual outcome, let's say it that way. And let's say that we don't know what the heck we're talking about. Let's say that we're way off on the valuations, okay? Then this is the amount of money that will be made from that. Long or short, meaning if it's not as bad as we think it is, then on the long side, they're going to make money. If it is as bad as we think it is, but there's another caveat to it, and then it spreads because of that caveat, this is how we're going to make money on the short side, right? It's these extrapolations that allow us to make money. That's why Net's move was so violent. That's why SMCI's move was so violent. That's why ARM's move was so violent. ARM's move actually got me to the point where I second guessed if I knew that I was right, even though I was in the trade, because what they said to me wasn't as great as the move until you reread it. We're going to get to that. But these are the basics, and these are what we're dealing with. Where we should go with this is right here. We should get into XLY and what the heck is going on here with names like Ralph Lauren, WSM. Right? What is going on? Like, why are these names just absolutely exploding to the upside? ELF. I mean, you can just literally go through the names over and over again. People will be upset because Lulu hasn't hit a new high in about a month, but nonetheless, why are we seeing this? Why are people going to Uber Eats? Okay, why is Uber Eats allowed to or able to charge $1 billion in ad revenue now? Like, it's insane. Right? Why is that stock doing what it's doing? Is Lyft going to benefit from this? Probably not. So where does this lead us? Okay, this leads us into a consumer-driven economy, but we don't really understand what's driving it. So I was reading this study, and to me, this study is it's absolutely fascinating. And it goes all the way back. So let's just jump into it. Now I want to reiterate something again before we begin. Number one, this video is packed. There are parts of this, hands down, that you're going to want to watch again if you want to learn. That's all I can tell you. I had a lot to cover, and I had a very short period of time to do it because I'm trying to keep these under 45 minutes on Saturday. Then I'm going to split these into clips over time. One of my other projects I'm going to do with my 1,000 things. But please understand, going through these concepts fast so that you can then watch them again in your own time. Sediment trader came out with this study. I'm going to be really clear what you're looking at. If you've been with us for some time, we've been doing this for a couple of years now. When we look at these things, we want to make sure that we know what the heck we're even looking at. So University of Michigan Consumer Confidence, that's great. What the heck am I even looking at? We're going to get to that. What I like to do and what I find most valuable is change in trend. So here's change in trend. So whenever we get over 75, something happens. Well, what is it that happens? Before we get to what happens, what sectors benefit the most from this, we really need to understand what the heck we're even looking at. The consumer confidence measures were devised in the 40s. This guy devised it, George, University of Michigan, shocker. A national representative survey based on telephonic household interviews. We call you on the telephone, we ask you a bunch of questions. Now you know how they're coming up with it. It gives a very accurate indication of future course of the national economy and the index of consumer expectations, sub of ICS, blah, blah, blah. Created to and still published with the following objectives. What is this supposed to tell me? Right? When I'm looking at this, what does it tell you? When you understand this, this is when you become deadly. And because you know more than everybody else. Then you take that knowledge and you apply it. Knowledge is nothing. Applied knowledge is everything. Assessment to the consumer attitudes on business climate, personal finance, and spending. Hey, how are things going? Right? I mean, seems like a reasonable question to ask somebody. How many people do you ask? Well, you usually in the preliminary figures, you're asking 300 people. You come up with around 500 people at the end. To create the capability for understanding and forecasting change to the national economy. Hey, are things getting better or worse? Things aren't really great right now. I'm paying, $15 a can for pinto beans. I'm not really happy, right? Okay. Direct, incorporate empirical measures of consumer expectations into model behavior. Do you think things are going to get better or do you think they're going to get worse? I think pinto bean prices are going to come down. Great. I think my burrito is going to be a little cheaper. Awesome. To forecast the economic expectations of future spending. Do you see yourself buying more burritos in the future? I do, if prices go from 15 to 12. Good. To judge the levels of optimism and pessimism in the consumer's mind. How do you feel about the burrito? Do you like it? Do you think it's worth the value? I do like the burrito. I'd like to pay $12 for it. Get it? All right, now you know what it is. Now, when you look at it, it's making a change. Do we care about this change? I think we do. So what Sentiment Trader did a really good job of here, in my opinion, was going through this and saying, look, every time over 75, this thing happens. All right, and what is that thing? Well, it's the market, and the market seems to be getting a little stronger. Okay, we can't really use that time because, as Jay likes to point out, $1.7 trillion came into the market, and NFTs were created, even though they're nothing but a JPEG and hold no value. So now you can see where you're at, and you're hitting 75 again. Well, that's a really weird place to hit 75 because all we keep hearing is that the end of the world is near, right? So then you just kind of go back through time and you look at the 80s and you can see when this happened. Well, that's a really interesting time in the 80s. If there was only another time that was anywhere near correlated like this, where you had the highest CPI that just came down, I don't know, maybe like now. Right, so remember how much time we spent on 1980s and how much that inflationary period is very similar to what happened now. I'm not going to bore everybody with that. But what I am going to bore you with is the fact that you're just turning. And when you get one of these, you don't just get one, do you? Here's two. Here's a conglomerate of them. Here's the one standout that's going to be different than what I just said, right? The outlier, there's always an outlier. Look how many you get collectively together over time. All right, so the consumer is back over 75. What does this mean? This is the data since 71 above 75. So what is this right now and why do you care? Again, this is Sentiment Trader. This is not me. Well, what you're going to do is you're just going to get these dates. And what you're going to note out of these dates is everything seems to smooth over time, right? You can start seeing even when you were in 1980 and this was kicking off, you have your outliers here where things weren't groovy, right? Things weren't going great. We were in line for gasoline, dependent upon your license plate, whether or not you were able to buy gas, if everyone remembers the Carter years. I was a kid, but I still remember it. So here's where you're at, and these are the numbers. And this period of time was not great in the 80s, which is very similar to now. So should we look at this and pay attention to it? I do. I do think, despite what I'm going to show you, I do think that we have to realize that this time in 1980 is now, to some extent, right? It's not as bad. So what does that mean? That means everything is one thing. And when I'm showing this data, you have to take it for what it is. It's one thing. But that one thing did pretty well, didn't it? A year later, you're usually up around 10% with an 80%, 79% win rate. But like everything else, the devil's in the details, isn't it? So what are we seeing here and what do we have to pay attention to here? This is what we need to pay attention to. How did these sectors do? What happened with these sectors? So this will tell you index data versus ETF data. And what is this telling us? Well, there's a couple things that should be really pretty average here. that you're going to get an average score, right? And that's going to be around 18%. And then what you're going to do is you're just going to see if there's anything going on that starts to stick out to you. And to me, there's a couple things that are sticking out, but I like showing the data because the data to me, again, the devil's in the details. All right, so sector ETF, after this confidence hits 75% 2005 to present. Simple enough, right? And what are we looking for? We're just looking for anything that would be sticking out. And so what we're going to go is just going to take a look at a year and then who does the best after a year? Well, there's the best after a year, XLY. That's interesting. Okay, that might be an interesting statistic. There's also another interesting statistic I thought here too. Look at XLV. And look at healthcare. Isn't that neat? I think it's neat. Why is healthcare outperforming? Well, maybe people are actually getting things done that they're supposed to be getting done. Maybe they're buying better healthcare plans because they have more disposable income, right? Maybe there's something there that we should look into. We can do that in another video, but I thought that was kind of neat because usually we look at it and say XLV, that's what? Well, that's defensive. But no, they have more money, so they're buying better healthcare. Something that's pretty fascinating, even though healthcare should be free, but that's a debate for another time. 27.3 is what you're looking at in a year, right? Okay. So when we start looking at this, and then we realize that we're playing with this because everybody wants to be in tech and AI like myself, this explains a lot about what's going on. Now, just how often does this play out? How often is this something that we should really be looking at? So I'm not going to look at a month or 6 months. I like looking at a year from the date that something happens. Okay. How often do we have a win rate in these sectors after 1 year? Okay, how about 100%? So if we go back to 2005 and every time that this crossed the line for the first time, you have a 100% win rate, meaning that these are higher. Forget the numbers, whether they're double digits or not. I have a 100% chance. So the first time that it happens will be the first time that it happens, that you go negative. And anything can happen, believe me. I've seen anything happen. Again, Sentiment Trader, I have no affiliation with them. They just do a really, really good job. And I think it's worth paying attention to the data that they put out. For me, it is anyway. And this is what I meant when I said this video is going to be packed. So now you can see the data in here 1 year later on the XLY, and you can see from '05 how they crushed. Okay, they absolutely crushed. I mean, you're having like tech years in Ralph Lauren in sweaters, for God's sake, right? So this might explain why companies like Hermes, Louis Vuitton, Ferrari are all hitting highs or record earnings. The comments so far on showing a P&L have been positive. Just a couple things to remember. This is one account. This account I trade this fairly aggressively. In other words, this account is linked to the Alpha Chasers community, and it's me being somewhat active in there, overly active, leaning more on the day trading or short-term trading side of things. And that's not how all my accounts look. So I just want to be really clear about that as I show this. But there are two things to take away from here that are really important. This is what we did on the day in there in this account was about 8. And what's important is number one trade that I thought coming into today was going to win. It was my single greatest loss on the day. And it's important to understand that just because you think something's going to be your greatest win doesn't mean that it's going to. And so the lesson there is you got to make sure that you keep your head on a swivel. Now, I think Mara is a dumpster fire of a company. It was my single greatest trade on the day in this account. On top of that, you can see MSTR right in here, and that is another great trade. So that company I actually like, but the company that I really don't care for was actually my best trade. And my worst trade was the one that actually had the best earnings report of the evening. And I think it's very important to remember that you're not always going to have winners where you think they're going to be, and you're not always going to have losers where you think you're going to be. Your job as a trader is to make money. It's not to tie your ego to a trade. But the characteristics of the MSTR trade and the characteristics of the Mara trade were very simple, and they are in the same category, but it warrants walking through the actual steps so you can utilize them yourself. And I'm going to give you exact indicators that I use to identify those so that you can do it yourself. Now, there's a couple things that you're going to want to use. We're not going to use RSI, but what we're going to use to identify this is we're always going to want to look at the underlying asset, meaning what are you trading? In this case, you were trading Bitcoin. I'm going to clean all this off for a second. So the very first step of this is you just want to look at the underlying asset, meaning if you're trading the copper names, for example, you're going to want to go look at copper futures and go and say, okay, well, where are copper futures right now? And make sure that they are in alignment. And you can see how copper futures are imploding. And you can see that based upon that, FCX is doing the same thing, SCCO, same thing. So they are in tandem to some extent, but this one's holding in there. So the very first thing you do is you look at the underlying asset. It's not realistic to see those names go up right? The Bitcoin names go up if Bitcoin's not going up. But there's also another caveat to this. You'll note that there are periods of time when the underlying asset, meaning Bitcoin in this case, will go up a little bit, but the underlying assets like MARA or MSTR, Coin, any of those names will automatically go higher, a lot higher, commensurate to where BTC is, right? Now, why is this important? Because that indicates, please listen to this part, that indicates that the cycle's just beginning. It means that the cycle's not at an end. When this started to end over here, if you go back to like the 11th, the 12th, the last time we had a cycle in here, and you take a look at something like Coin, what you'll see up here, look when this started to end. Okay, see where Coin started to end? If you go and take a look at Mara around the same time, you can see how this ended before that Bitcoin ever got to that high. So what is this telling you? This is telling you that when you first start moving, when the asset, underlying asset first starts moving, that is when you strike. You strike first, you strike fast. Because eventually it'll grow into that. And then what you get, if you watch that video on reflexivity, I'm going to clip that out. It was about 2 weeks ago, I did that whole piece on reflexivity on how I'm able to identify some of these things ahead of time. And what you get is these are your expectations on what's going to happen. Let's put this on for a second because this is critical. So you put here, and these are the expectations on the outcome, okay? And this is what everybody expects is going to happen. And this is kind of where everybody is, right? And then what happens, you get to a point here where the expectations may actually be here. You're still here at first, right? Over time, what happens is as these start to move, the expectations could still be higher than you think they are, but everyone may be aware of it now. And so the actual rate that you could make on the trade is here, right? Versus if you're looking at it differently and you're first in, well, what you could make on the trade could be that, right? I hope that makes sense. So you want to get in first. Very simply, if you think about when we talked about it from a standpoint of, we looked at ARM to explain reflexivity and what happened with ARM, it's relatively very simple. If you look at ARM and that trade, and I really want to get this concept down because I think it's very important, 5-minute chart, and if we just zoom in here and zoom out, well, this was really clear on who made the most amount of money, right? It was the person that understood here that they should be in the trade. So we went through this trade, you know that we were in it here. So we knew what to look for. We got involved. You can see all the trades, the timestamps. I showed it in the journal. I've showed all the timestamps, everything. Purpose of me showing this is where was the most amount of money actually made on this trade? It was made when you first got in it, right? So what I'm saying is if you know that this is the potential outcome, but the potential outcome could be even greater, like if you thought that was the potential outcome, but if the potential outcome could be even greater than you think it can, and you're in here at that level, well, you're in at a level where you have the ability to make this. Now, if you waited till after the conference call or to the conference call, your level of, if this was the outcome or expected outcome was here, then you don't really have anything, right? There's no real edge on the trade. And then it sells down, and this is when people buy, and then they wonder what they're in, right? Okay, so then the next day when you open up, you have a whole litany of people that know this news now, and they want in. And that's the level of outcome that they could make on that trade versus the person that got in here, and that's their level of outcome, all right? Strike first, strike fast. Think of it that way, but you want to make sure that you're in the right space because as more and more people come out, well, what do you have now? Well, now you have a situation where the guy's on CNBC. Well, now you got another guy on CNBC saying, oh, well, do you really want to be in it? Or maybe you don't. Like you're getting different views now, right? So now the people that are looking at this, that are looking for this trade, and I'm doing this on a short term, but you could do this on a weekly or whatever, their value creation's here, where yours is here because you're first. Strike first, strike fast. All right, it's the easiest way of saying it. Now let's get back to the trade so I can give you exactly what I look for besides what you're seeing with Bitcoin. So one of the key functions here for this trade is relatively simple. I don't really care about anything when it comes to an asset except where I'm at along the line. And the biggest line for me is just going to be that 55. I use a 12, a 22, and 55. You should use whatever you're comfortable with, but I want to watch that and I want to see how that plays out. Now, from that 55, and I can see how the asset's moving, then we start seeing these names move. And what happens here? We get above what? The 55. Now, what I want to look for here is I want to look for the close. I'm most interested in the close. So I'm above the 55, and then you'll see it here as well. I'm above the 55, but where did we close? We closed at the high. So we're above the 55, we're closing at the high. Where are these bars? They're solid green, both of them, solid green. Okay, you have a little bit of a wick here, but they're really what's called a Marbuzu white. What else do you have? You have a gap in a chart. It's always better if you have the gap in the chart. You're not always going to get that, but I think that's a very important distinction, right? And you can also see how this was not anywhere near as long as the other bars, which didn't make that the right candidate. But once you're here, you know that you had that kind of pressure. You know people are going to pick this up overnight. You know they're going to pay attention to it. The next thing that you want to look for is you want to look for volume. So you're closing over the 55. You're closing on a pretty solid green bar, very long, that's encapsulating a large move in a very short period of time that was unexpected. And the move is bigger than the underlying asset. That's a really big part of this. Next thing that you want to do, you want to take a look, and I'll tell you exactly what it is. This line right here is a 50. So you put in on your average, you put a 50 on volume. And when you are over there, you want to pay attention to those. And then what you're doing is you're just clicking through them. Now, to be really clear, you see how this volume actually got more and more and it kept pushing, right? So this fit that criteria. Now you could say and reach out and go, well, why didn't coin fit that criteria? Well, coin never got over. That's why coin was never in that criteria, all right? And so you can kind of root through the criteria that way as which ones do you want to look for? Well, this one was good, right? And you can see that this one fits the same exact narrative, or does it, right? So why wouldn't you do Riot? Well, Riot is right here, getting above the 55 today, was not above the 55 yesterday. So why would I want to buy something that has less relative strength than the underlying asset? I wouldn't, right? You might want to listen to this a couple times. So what I'm getting at here is what's above the 55, the underlying asset. Okay, so are we above the 55? Yes. Did we close at the high? Yes. Is this an elongated move that was more significant than the underlying asset? Yes. Was the volume above the 50 SMA line significantly showing outsized volume? Yes. Fits the criteria? Fits the criteria. That's why I chose those two. And on Thursday, we bought stock and we bought calls, and then we came into obviously a very nice surprise, which quite frankly wasn't really that much of a surprise. And if you listen to that criteria, you'll be able to spot these for yourself. Now, to be abundantly clear, here is a picture from yesterday. You can see that towards the end of the day is when I was able to put this on. I wanted to get as close to the end of the day as possible. And then when I saw it starting to develop, we did it. We did stock and calls, or I did stock and calls, but we paid 30 cents for these. I believe we sold them at $1.20, something along those lines. And these we paid 18 for and sold them at 42. And then we were also long stock in both, and I think this is it. Let me see if I can find it. Some people held the calls. These are just ideas, guys. You don't have to do exactly what I do. Some people held the stock. They did exceptionally well with it. I didn't like the action in the beginning of the day, and the way the market's been lately, I feel like a cat in a hot tin roof. But you can see here, we pulled $40 out of the stock and then sold the rest for 30. And then the options on those, 42.75 from the 18 3/4, pulled that out. And then we sold for $1.25 and we paid 30 cents for it. So overall, it was obviously a really good trade. Does it continue? Maybe. When you have breaks like this, yeah, you might want to pay attention to it. There might be more trades here. When you're getting that kind of volume, you want to pay attention. I always get concerned about the second gap. That usually concerns me because sometimes that's a period of exhaustion. It doesn't even matter how far apart they are. Sometimes like 1 and then 2, you usually see a reversal, right? You can see it here again, like 1, and then you get another gap up from here, reversal, 2. So you always just kind of want to watch that. They usually come in 2s. At least that's been my experience with them. But quite frankly, if that might be a time to go take a look at them again. As long as Bitcoin holds here, you just want to make sure that those criteria are met, and you want to make sure that these names are actually continuing to outperform the underlying asset. Now, I really want to hammer this concept home because it's such an important concept for people to get. And I'm going to clip out that piece on reflexivity, and I'm going to make it a separate video. But I really want people to get this. So we entered ARM right around here. And the reason that we did was based upon the NVIDIA conference call and what came out of that conference call, and then what the research started to say. And as I always try to let people know, the way that I view everything is that stool. Whether you like the stool or not, I don't really care. But I always look at the market as macro, fundamental, and technical. And then after that, I'm just going to draw a little top right. And then you're on that stool, and then you're going to be leaning on each of these legs. But when you start to see a fundamental shift, you want to pay attention to it. And when you started to see that shift come out in the research notes that NVIDIA's conference call really benefited ARM, and you saw people not paying attention to that, it created what we're referring to here, which is that reflexivity, where you have a line here, which is the potential outcome, and you have what everybody thinks is the outcome, and you have that dispersion. The sooner that you can realize this, meaning if you can go out weeks or months and realize that, you can really get ahead of a trade. And that's what we did here. Now, the question again is, do you want to find it out here or do you want to find it out here? And you don't know. You don't know if this is the outcome, because this is the outcome that you're predicting, but you don't know if it's going to be up here, and you don't know if it's going to be down here. But one of the things that's most important about this is that whether that outcome is any one of these, but if you think about it, you want to be where for that outcome? You're going to want to be towards this level, right? So it fits in again with strike first, strike fast. You want to get in, and if you're wrong, you're wrong. You sit back, you watch, you wait, and you go from there. But this allowed us that opportunity, whereas other than that, we could have been getting in here, and it could not have been that great, right? Or we could have been getting in, as some people are, getting in up here. And that's not what you want. You want to get in ahead of time. And as far as people saying, I day trade a lot, it's probably 25 to 35% of what I do. The amount of money that you can make swing trading and building positions over time is significantly greater than anything that you can do in day trading. And it's just a fact, because you can actually build a position over time. It's very, very different, and you don't have anywhere near the amount of capital outlay, nor do you have the amount of risk that you have to take when you're doing a day trade, right? Because you have to be so levered to do a day trade. So as you grow your accounts and your accounts grow, you want to start thinking like that. And here, drop that in so that you can see this. But this is when we first got involved in it, and that's going to put us right around this level in here when we first started buying. And then again, the first sell, we had another ad after this as well, around 70. But I really only trimmed a little bit of this out of both of the long-term positions into this. There's really very little reason to not try to stay in this and see what the next quarter brings, because you just don't know how long this is going to go on for. And that's a really important distinction. And that really ties us into the next portion that I think is very important. We have no idea how long the video pushes for. We do know one thing: there will be a correction. We just don't know when. Right now, if it keeps beating earnings and it gets this excessive, this is definitely something for us to watch, right? I mean, we have to remember back here to here, this is when we were told, but people were saying it's a fad. You're up 338 points since that day when it was told that everyone was telling you that it was a fad. That's why it's so important to call your feed and watch who you listen to, because people will be out there and they're just very simply making content for YouTube ad revenues, or click on my Twitter link, get my newsletter, all of that stuff, right? That's what they care about. They're not actually trading. And so they're just trying to get clicks. And you have to understand that about a lot of the social media stuff. But when you broke out here and everyone's saying, oh, it can't possibly last. How long could this possibly last? Well, here's your base. You have a 9-month base where you exceeded earnings estimates 3 quarters in a row, and you never broke out from that, right? You just kept getting tighter and tighter until you got into January, and then there's the break over the 5, right? Now that is a pretty decent push, but are you extended over this? Yeah, you're pretty extended over this by any real metric that you're going to use. If you looked at this on a fib level and you just dropped, let's just take from the base out, right? And take from the base to the gap down. We'll do it there. And then from there, what we'll do is we'll put in the settings and we'll just extrapolate out. I'll put the 0 line in so you can see what I'm working with, and the 1, and we can kind of go from there and put all these in, kind of see how this played out. But really where you're getting to now is you're up here to be at the ultimate level based upon that base and that breakout from here based upon fib levels. You're up there. Isn't that fascinating how that 1618 actually held there for a period of time? That 631, we couldn't figure out why it was an issue. It's actually a fib level. But you can see what we did there was just measure the base, right? And we measured from this level, the gap, to the top of that, and then it actually gives you that fib level. It's kind of fascinating to watch. It is for me anyway. But so what are you going to get to here? I don't know. But if you're up here, you have to realize how far off this you are, and the retracement that could go on is pretty staggering if it did get up here. So that's just something to think about. But they're out there. And I want to just touch base on this. You can always have one foot out the door. You don't have to go home these, but you can't be looking at these and just saying, oh, they're just going to constantly drop. I mean, I look back at this and realized that the other day I was trading this on the short side here, and I did okay with the trade. And even this day we were short and we did exceptional. But then you realize that you're short, and then from that low to where you close at the end of the week, you're up another 130 points. So how many times are you going to want to miss that? And the answer to that is no, that is not FOMO for the people that are going to say that. What I'm saying is This is what's happening. And you can either trade what's happening or you could argue against it and say, this is silly, it's going to end. Well, we opened at the low, we closed at the high. Okay, that's what happened. No matter how we look at this week, you opened at the low and you closed at the high. That means you had buying all week. Now, how much buying and how much longer this is going to go on for, we really don't have a clue. And if we just, again, if we do the simplest of things, and I think it makes sense to take a step back sometimes and do the simplest of things and just look and say, all right, well, we're going to go from here and that's going to be our level. And then from that level, we're going to use that gap and we're going to see where we're at. And again, I just find it so fascinating when I drop these. Look how you just stopped here at the 1618. But based upon this base, you're way over 663. You blew through like water. The only other fib level that's going to get you up there is this 852. Can it happen? I mean, it would be less of a move from here to here than what we just had. So can it happen? It could, but my suggestion is to continually trade these on the long side until the party ends. And when the party ends, quite frankly, the party ends. And there's really nothing you can do about it. You don't look at this now, and this boils down again to what we were trying to talk about, or what we were talking about. I'm going to just hammer it home all this whole video, but I really want you to get this. Is the risk different here than it is here? Yeah, of course it is. But you don't know that if you're going to stop here. You don't know if you're going to stop here. You don't know if you're going to stop here. You just don't know. And anyone that tells you that they do know, you don't. But is this trade more risky now? Oh my God, yeah. You could come in one day and you're down to 600 and you might think it's over, and then the next day you're at 500 or 4, right? You just don't know what's going to happen when this starts. I don't think this will happen, but could it? Of course, I've seen crazier things. So, in doing this 20 years, I've seen some crazy things. So what you want to do is maybe you don't spend that much time in this building a position. Maybe this becomes just something that you're in 1 or 2 days and you're just following a very simple process. One of the processes that I'm really trying to push education this year with this. I went back and looked at the year videos, and I think I could just do better with the educational side of this. And that is really important to me to focus on. And you can just scale out of it. Like the same way that I was scaling out and showing you how to do these with day trades and showing positive slippage, you could do the same thing. Let's say that you're getting in off some kind of DTL here and you're in. Very simply, as it trades up, just scale out of it. Keep a core position and trade out of a partial. Pulls back, scale out of more, right? Pulls back, doesn't hold, close the addition. I mean, what you're doing is you're keeping a core position and trading around it, or you're putting on a position when you see something that you like, and then from there you're scaling out of it, and then you're just looking to wash, rinse, repeat. I do that all the time, especially in this kind of environment. I would never go home with a brand new full position in something like this. And I think that that's some of the nuance that's lost on newer traders when we're discussing these things and saying, oh, just hold it. I'm not suggesting, like, let's say that you're going to hold, let's say your max position on something like this is 100 shares or 1,000 shares. It doesn't matter. Size does not matter when you're discussing accounts. It matters after a while with liquidity, but for our purposes, it's not. But maybe you're going home 250 or 300 shares and your normal position's 1,000. And then you come in and then it's down like $10 or $20, and then you're looking for spots to buy, and then you're adding to it. Then it trades back to break even, and then you're selling a portion and holding a portion, right? You see where I'm going with this? Doing that kind of stuff here, that's what works here. What doesn't work is saying, I'm not going to participate because the stock's too high, because you don't know how this ends. You really don't. And what we're seeing is we're seeing companies come out and consistently beat and exceed earnings that are in this industry, and it's not stopping. So you can either be a party to it and take something out of it, or you can sit there and say, this shouldn't be happening. I'm going to wait for it to correct. One way will make you money. Even if you're right the other way, who cares? You still didn't make money, and that's your job as a trader, to make money. If your job as a trader is to make money, there is no one technically, from a technical standpoint, and technical, remember, when we do macro, right? When we do the macro, remember what macro is, and then this is really what's important about macro when people start understanding this aspect of it. Okay, macro is what? Let's make that a line. Macro is what? Okay, that is the who, okay? So who is the macro? What, okay, is going to be the fundamentals? When is the technicals? Okay, so you can have this. You can have that, hey, money's flowing into this sector, right? Because right now it's the ease of financial conditions, and we're going to expand out and growth in the US, blah, 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 macro issues. Okay, that money is going to flow into the top companies. Who are the top companies? These are the top companies, okay? Should I buy them now? I don't know. Let's use technical analysis. So in other words, when you're using the who, what, when of that, this is not telling you now is an ideal time to put a short on. by any stretch. You can go and look and say, well, we're really overextended, right? We're super overextended. And I did a whole video on this when I first started doing these educational videos on RSI. And people will say, well, the weekly's at 87. Okay, that doesn't mean anything. It only means something when it cracks. What if it stays here for another 3 months? And I'm not saying it's going to. What if it does? What if it rides that line for a period of time, right? The same people that said, oh, it couldn't happen here in May, and then it stayed up to here. Okay, so what did they miss? Another double? And I'm not suggesting that it's going to double from here without any kind of pullback. But what I am suggesting is instead of looking at this, use the technical analysis aspect of this to determine when you would put a short on versus just saying it's too high and it shouldn't be here, right? Fundamental analysis and macro analysis is no reason to put a trade on. Zero. Now, we covered a lot of ground today in a very short period of time. So there's parts of this still that I want to hammer home, and there are parts of this that you're probably going to want to watch again. The one thing that I really want to take away from this, that you should be taking away from, is nobody really knows what's going to happen, but it's your job to understand where expectations are versus where the possible outcome could be. This is where people get tied up in trading. For example, like Uber. Now, everyone will say, well, Uber's doing this, blah, blah, blah. Now's the time to get an Uber. Well, the person that understood it back here, right, in 22 is obviously going to do better than the person here, okay? And yes, there are technicals, so maybe you're not buying there. Maybe you're watching that bar develop, and then you're watching till you break out of that bar on earnings or something like that. But the purpose of understanding this is if when you start looking for what can happen, and you start looking for the chances of the outcome being greater or less than people expect, because less than, you just make money on the short side, right? For example, let's say that NVIDIA does blow up, right? And you are right, and that AI is a myth, which I don't think it is, but we'll get into more on that on Monday's video. I have something else I want to cover, but we're going to do the majority of it there. But if you start looking at something like NVIDIA and say, oh no, it's completely wrong. Well, if the outcome is to the downside and you're right, well, you're going to make an absolute killing, obviously, correct? So it can work both ways. And this is a really important concept. And nothing pointed this out more than the home builders. So we were trading the home builders a little bit ago, back in here in 23, and what we were getting actually around October, November 22 into 23, and people kept talking about this huge crash because rates were going higher, and they were missing the devils in the details, as always, that we're short 6 million homes. And if you're short homes and you don't have supply, well, this is a really very simple trade, right? So that, again, you had outcomes that people weren't expecting, and that's what you're seeing now in names like Arete, where these names are hitting all-time highs because the consumer's bad, because we're at all-time high debt and all-time high credit card debt. But then as we just showed, the consumer looks pretty good, right? So now you have an outcome, and that people are talking about this outcome. Oh, well, it's China. China's going to be bad. Well, University of Michigan Sentiment Survey does not take into account China. That's one reason why it's really important for you to understand what you're looking at when you're looking at it, right? So that is why we spent time earlier in the video going through this. So when you look at names like Louis Vuitton, you look at names like Ferrari, and you see these names absolutely exploding to the upside, and then you hear people talking about things along the lines of, well, AI names can't possibly go higher. Can't they? Maybe they are going to go lower, but can't they? Well, where's all this money coming from? Can you believe he's not cutting rates? I don't know. Ferrari has a 2-year backlog. You can't buy a Lamborghini right now. They're putting $75,000 in all new Porsches. If you can even buy one. If you want to go buy a GT3 RS right now, you have to go spend $2 million in other Porsches to even get on the wait list. Does that sound like something? And then you look at student debt and where they put their money. You look at the patterns. Look at how this stuff is just continuing to break out, okay? Look at ANF. One of the trades that we put on that I keep hearing is just going to crater on me, and we bought it at 70. Has it cratered yet? This is the kind of stuff that you want to focus on, right? Because this is what makes the difference. And understanding these nuances, I'll give you an example of where you should think, how you should think about this. In front of you is net income. The blue line is NVIDIA. The gray line is Apple. Now, if someone told you in 23 that NVIDIA was going to have better revenue and better net income growth than Apple, you would have told them that they were crazy. Maybe better growth, but more net income? You're out of your mind. Nobody would say that. Right? And then you look at it and go, okay, well, there are a couple things to take away from with this. Number one, I made this comment last May, told people to timestamp it. I just put it out there again. I never got more hate on a tweet. I don't know why it says promote on everything. I'm not trying to promote them. But I never got more hate on the tweet. It was absolutely insane. I didn't understand. It's all a scam. They're buying their own chips. That's why Sam Altman's over there right now in Dubai or wherever the heck he is trying to raise $7 trillion to go build more plants, right? Okay, we'll get to that on Monday. But I never got more hate than this video. And so then you look at something like, well, Apple. I mean, Apple's the way to go, right? And then you think about it and go, well, is Apple the way to go? Because that's Apple's new product. Do you want that? Do you want to be that dude? That product's $3,500. This is what Druckenmiller had to say in June 2023. And I put this clip from Bloomberg and you can go find it out there. Or do people want the product that's going to make coders 7 to 8 times more productive? That's going to make their lives more productive? What do you want? Right? So when you look at something like this, do you want to listen to the guy that's a billionaire? Do you want to look like that guy sitting in a Starbucks? So the fact that this company could exceed Apple's net income might be an outcome that people did not expect. And it's possible that that outcome could even be greater than most of us are even anticipating. It could also go the other way. And that's what makes a market. That's it.